If you've been paying attention to financial markets over the last few years, you almost certainly have heard people talk about private credit. Very simply put, this is when a company borrows money from a fund rather than from a bank or by selling bonds in the public markets. Private credit has been around for years, but it really got a boost after the financial crisis of 2008, because that's when tighter regulation on banks pushed borrowers to seek other sources of financing. Since then, it's grown really quickly. Private credit assets are now around $2 trillion, according to the OECD, more than twice what they were a decade ago. And for context, that's equivalent to about 12% of all corporate bank loans. So this week on The Big View, we're going to delve into private credit. It's what we do at Reuters Breaking Views. We tap our best sources around the world to bring you fresh insights into the biggest stories on global business and finance. I'm your host, Peter Thalassen. In a moment, we'll hear from our guest this week, who is Marc Lipschultz, the co-CEO of Blue Owl Capital, one of the largest US non-bank lenders. But first, I'm delighted to welcome Jonathan Guilford, who is a Breaking Views associate editor in New York and also our in-house expert on all matters related to private credit. Jonathan, good to see you.
Hey, Peter, great to be here.
So, Jonathan, you've been following this industry for a long time and writing about the players in it and kind of what they're doing. And I think you've also actually done a podcast with Marc Lipschultz before. But tell me, what is it about this industry that is kind of interesting to you right now?
Sure. Look, I come from a background of covering M&A for a long time. And so what was interesting to me at first was just a bunch of private equity guys were suddenly eating their own banker's lunch. You had the Lev Fin desks at JPM or Morgan Stanley or Goldman or whatever. And all of a sudden they had to worry like, oh, there are these big pools of capital sitting inside what I typically think of as my clients. And now they are able to kind of fill a need among, private equity firms, among companies doing kind of niche, weird little buyouts. I'm not in that market anymore. What's happening here? And then that kind of grew further and further, right? And that's sort of what we usually, for the past few years, have been talking about when we talk about private credit. It's this thing that we dub direct lending that is a direct competitor to really a bank's Lev Fin desk, and it's kind of serving a lot of private equity firms as they do deals. That's changed a lot in the last few years. We're really talking about a much larger, more comprehensive set of investments now that pull in insurance, they pull in kind of asset-backed finance. It's this much, much broader set of things people are talking about. And it's like part of a much bigger media conversation about how the financial system is changing now.
Yeah, I think that's one of the interesting things. I definitely remember in sort of 2020, 2021, sort of immediately after COVID, when the banks were under all sorts of strain, and suddenly these direct lenders were getting involved and writing really quite big tickets. And yeah, as you say, sort of easing the banks out of sort of financing buyouts and stuff like that. But then since then, we've had them talking about doing asset-based finance, really kind of taking on a lot of these other sort of functions that you would normally associate with banks. So that's really interesting to explore. Tell me just a little bit about Marc Lipschultz. What is it about him that makes him a particularly good person to give us a view on this whole industry?
Marc has been through really a lot of the stages of the evolution of the industry. He sat at Goldman, he sat at KKR, and now he sits at Blue Owl, which itself expanded through merger and listing years ago. It's really, he has a very, very good front seat to what's been happening here and kind of bringing this conversation full circle from where we were 2 years ago when we chatted, when, as I said, a lot of the conversations was really still about that narrower idea of direct lending. It's interesting to see how much that has changed and also how much all of these firms now have to think about sort of broader systemic questions about how they go to market and how they design their funds, such that, they're solving like these really nettlesome questions about, how much liquidity do I offer my investors? Do I want to try and tap the individual wealth market? Am I mostly thinking about insurers? Am I mostly thinking about traditional LPs? Like, there's a really, really interesting set of questions that have come up in that interim. And Mark is just kind of, he is one of the people at one of the largest US private credit shops really having to deal with that every day.
Okay. Thanks, Jonathan. Let's listen to your conversation.
Okay, Marc Lipschultz, it's great to have you back on the podcast. Thanks so much for joining us.
Great to be here and great to be back.
So it was roughly 2 years ago that you and I last chatted on this podcast. And in the meantime, I think there's been sort of a big picture shift in what people talk about when we talk about private credit. Back then, a lot of the conversation was revolving really around kind of straightways direct lending. It's become a sort of bigger and more complicated market that everybody is focusing on right now. Could you maybe step me through kind of, I guess the question is, what is private credit and what is that now? How has it changed and how Blue Owl stands within that?
Well, it's an outstanding question. You're absolutely right. The world of private credit has evolved pretty materially over the last 2 years, maybe in an accelerating fashion. I think it actually mirrors a broader and longer term trend, candidly, which is this continued evolution of the private marketplace as a complement to, some might argue, a substitute for or a competitor for. You can pick the word you prefer. But it's really been a 30-year arc, and I think we talked about this some last time, on this migration from a world dominated by public markets and the public markets sort of always being available and the private markets being these highly opportunistic on again, off again partners. If I go back to when I joined the LBOs, as they were then called, private equity industry in 1995, to today, across alternatives more broadly, you've got this almost inversion where the public markets, well, certainly the public markets have become a less significant source of capital. That's clear. There are far fewer public companies. And over time, a declining share of the market in syndicated loans and the like.
Right.
And so, and also more episodic. The public markets go hot and cold rather dramatically, and therefore access to capital is rather hot and cold if you rely on the public markets. The private markets have become both larger and steadier. And so I think actually the third, from my point of view, the sort of the 30-year arc, there's a bit of a microcosm in the last 2 years and maybe an accelerated version, which is other parts of the marketplace. First, it was private equity. And then over, let's just use a 10-year from perspective here, the first 8 years of those last 10 years were really about corporate credit developing down the path of private equity and there being a really healthy, vibrant corporate credit private market. And now the last 2 years, I think we've seen other parts of the marketplace add on. So asset-backed lending being a prime example of one that, again, used to always live in public markets or regional banks, as the case may be, and now is moving and starting to shift toward the private market. So, I think you're absolutely right. We have seen a meaningful breadth, widening of what is available and applicable in private markets. And I also think, frankly, it reflects the most important trend of all, which is, look, private markets in many instances work. They work well for the user of the capital, and they work well for the investors.
Putting it in purely mercenary terms, right? I was speaking with someone in the market recently, and they were saying, like, look, we are reaching the point now where if you're sub, say, $40 billion in AUM, like getting through to the other side, like developing that capacity to, have that sophistication to offer checks of a reasonable size such that, big blue chip borrowers are going to care about dealing with you. Like that's really the cutoff, which sort of surprised me given that we still have so many of these firms floating around that are smaller than that. I mean, does that sound overly simplistic to you? Does it sound realistic? Like, because obviously Blue Owl has been pulling in like a ton of new capabilities by acquiring some smaller firms recently. Is that what's driving it?
Yeah, I don't think it's oversimplified. I mean, I would put it more in the category of, sort of Occam's razor, right? The easiest explanation is likely the best one. And I think that is the easiest explanation, which is it turns out to be relevant to have the capabilities and the depth of capital and variety of solutions that a user needs, yeah, you need to be, substantially larger. And I don't know what the magic number is, and I'm sure there's a magic number, but it is much larger than any of us would have likely thought 5 years ago. And it does attach very much to the Blue Owl acquisition strategy. There's something that, and if I had to pick another magic number, only by observation, not that I can give any theory behind what I'm about to say, but there seems to be something that happens around $10 billion of AUM where there's kind of a bit of a fork in the road, which is you go from being a bit more of and they used to be a pretty sizable firm, right? $10 billion is not a small startup organization by any measure.
Right.
But it used to be you could be just a monoline, kind of niche focused investment firm at that scale. And at that moment in time, now what's become clear is you have to sort of, from there, to get bigger, you have to develop operational capabilities. And I mean legal compliance and reporting. You have to develop fundraising capabilities around the world. You have to be able to tailor products and structures to meet the bespoke needs of whether it's large scale LPs, institutional scale, or individual investors, wealth products. And at that point, you end up finding, I think, that the people in these $10 billion firms have to decide, do they want to keep spending their time really being focused on what they're great at, which is being investors, or do they really want to spend their time trying to be business builders? And let's just use your number, try to cross the chasm from 10 billion to 40 billion. So when we were lucky enough to have Atalaya, for example, join us to develop the asset-backed strategy as in combined form with Blue Owl, I think it was very much about, hey, these people are the best in the business at investing and have to decide, should I spend my time and energy trying to build the business, or should I keep being the best at actually delivering for LPs? And they said, listen, I can join a platform like Blue Owl, put all my time and energy back into the investing piece and leverage the ability to scale off the back of Blue Owl. And that allows us to, I think, be a win-win solution, right? That allows the LPs to do better because they get the people like Ivan Zinn and others who have been doing this for 20 years, can spend all their time and their experience investing in the LP capital. And the Blue Owl team can help support the scaling and also share intellectual capital ideas origination across the whole platform.
Right. And what I kind of wonder is whether that tells us anything about the state of these two emerging, because I think maybe this is overly simplifying it, but if you break down the kind of the big trends that people are thinking about in private credit, right, it's still direct lending is still kind of the core of a big part of the business. And then alongside that, you have asset-backed, which is, developing that kind of, people talk about this as everything from like investment grade replacement through to kind of more interesting esoteric niche stuff. But that's the kind of debt that like really attracts people looking for the safety of securitization. And then you have a bunch of other pieces like, kind of infrastructure, real assets, et cetera, in another bucket. I mean, just starting with the first one there, like what does that, I guess, drive for consolidation that we're basically getting at? Tell us about the status of direct lending. Because obviously you talk about dispersion in management capability, sophistication, and we do see dispersion in, say, credit quality metrics, not in defaults mainly, because that's not really the way this market works, but certainly in terms of credit support people are looking at, or in terms of interest coverage ratios of portfolio companies. Like, is there a spread there? Are there people who are going to be stressed as we go through to the back end of this credit cycle now that interest rates seem to be at least settling?
Yeah, you are seeing a dispersion, and that dispersion is creating a really interesting market structure that is driving the very, consolidation or kind of getting bigger point that you so, I think, interestingly put your finger on. So you look at a business like ours, and I'm not saying this to talk glowingly about Blue Owl, but to make a point, which is our running loss rate has been 7 basis points a year. Our default rates are is well under 1%. The idea that you're going to outperform us, and it's not just us. There are a couple other wonderful scale firms, and the idea that you're going to outperform in credit is just, it's not realistic as an ambition. We have the resources, the processes, and again, I'm not saying this complacently. We wake up every day to fight this fight and do it well. but you're not going to outperform us on credit. So what is the proposition? So you can try to get nichier and nichier and nichier, but at some point, as a credit investor, let's keep an eye on who do we all work for? We work for the LPs. I mean, all of this is mechanics and structures and complexity, but it all gets down to delivering a really compelling return for a very moderated risk, right? Lower risk, better. I mean, that's the heart of all of these, whether it's investment grade substitutes or non-investment grade substitutes. And so if we've got the credit part and the engine really working, what are you seeking? If you go all the way to a super niche strategy, you might want those people investing dollars in that niche, but why would you want to allocate money to that niche when, 6 months later, okay, that niche isn't the place that has the compelling risk return? So again, I do think this leads us back to scale, which is, sure, there are some incredibly interesting niche strategies, but I think the investor is best served by having those capabilities ultimately reside inside of a more generalized, and I don't mean it to be all things to all people, but within the world of private credit, having multiple capabilities. I don't see the point of investing in a NAV loan fund, and I'm not denigrating the strategy. I love the strategy, but we do NAV loans. We've been doing them before it was an idea to call it a NAV loan strategy. We'll do them when they're compelling. We can do them with our insurance platform. We can do them in our direct lending vehicles, depending on the nature of the loan. And there'll be times when that's a really good idea. But there's times when that's not a good risk return. So why would I tie up dollars in just NAV loans? I should give it to someone who's good at NAV loans and other things.
I'm kind of curious. That intersects interestingly with a thing I wanted to push on, which is about kind of the plumbing of the fund system. But just for the sake of listeners who might not be super familiar with the subject, can you maybe just give us like a little capsule description of what a NAV loan is?
Absolutely. And I do apologize on my propensity to maybe use terminology. I will endeavor not to do that because, of course, we use these ridiculous acronyms every day, and so it's all so familiar. So a NAV loan, and it's one of an example to the point you've been driving toward of this continued evolution of private capital solutions. A lot of times they face off against the private equity market just because those are sophisticated power users of capital, right? So it often may live there. So a NAV loan is part of this private equity ecosystem. In fact, maybe let me describe the arc of the private equity ecosystem, because there's credit that shows up in multiple places in this ecosystem. So a firm goes and raises, fund number 5, a PE firm XYZ.
Right.
And every PE firm then immediately starts with one kind of credit, which is a subscription line. A subscription line, which is an IG, investment grade form of credit, is just an advance facility where you take these commitments that this PE firm has, and they say, gee, rather than have to call capital every time we make an investment, or quite frankly, even so we can let people hold on to their capital for longer before we have to put it in the ground and start earning that IRR on it, we will borrow money that is essentially secured by the right to call commitments. That is a bank or a non-bank would say, well, sure, if you've raised $1 billion of commitments from big institutions around the world, of course, we'll lend you hundreds of millions of dollars in advance of you just calling to pay that back. Like that's easy. That's good credit. So you start in a really easy place, but credit instantly enters the equation, and almost every private equity firm uses that today. 20 years ago, they didn't.
Right.
So this is kind of part of the evolving ecosystem. Then you start buying companies, and in each of those companies you buy, you will use credit, right? You will put in equity, and then you will use what we are calling the classic private credit, the classic direct loan, to finance the purchase. So you'll put up, simplify it, someone will put up half the money in equity, and they'll borrow half the money from a private lender. So then there's credit shows up in that place. Now we go forward and we build a whole portfolio as a PE firm of investments. So now we have 20 different portfolio companies, and we now have invested our $1 billion. And we say, okay, well, now I got to think about exiting. Well, one thing I could do is now I've invested $1 billion. And in fact, if I've done my job well, it's worth more than $1 billion. And I may not be ready to sell the companies yet, or all of them, but I could go and borrow against the whole portfolio. So I can say, well, listen, I now have $1 billion I invested. The billion, according to my mark to market, is worth $2 billion. We could debate what we all think it's worth, but that'll be part of the analysis of the lender. But in any case, let's say the P sponsor thing is worth 2. It doesn't matter. Pick a number. Let's suppose we all thought, well, it's definitely worth 1.5. You've successfully invested. Would someone, appropriately and logically have a good loan, make it lending you $400 million against that portfolio so you can return that to your investors while you then sell companies as is opportune? Absolutely. So that's a NAV loan. So a NAV loan, just to follow that whole track, is the other side of a subscription line. It is as I start to take money back out of my funds after I've made the investments and started to experience success and want to get money back to my investors, even if I'm not ready to sell each individual company.
Right.
So all those places intersect in the world of private credit, and we can throw one more in it. The GP itself is saying, oh, okay, I need money to put my commitment in for the next fund I'm going to raise. I wonder where I should get that. Now, I could get that from Blue Owl's GP stakes business. In fact, that would be one common form. We do that. It's big business. Or likewise, in that arena, we'll lend people money to their GP. So there's credit. None of it overlaps. So I don't say this to get people either confused or concerned about the interlace, but rather to say credit infuses this system in so many different steps. And a NAV loan, net asset value, which is what that stands for, the net asset value of the fund, is one place it shows up. And I think you want people like us, if you're an LP, I think it strongly favors people that have multiple capabilities to say, well, there's different times where different parts of that will present the right risk return. That's when you should make those loans. When it's not a good risk return to be in a NAV loan, well, then don't do it.
I do just wonder, so obviously that implies this whole system of plumbing around not only the way that credit provision to your customers is working, but also for yourselves, right? Because there are also, subscription lines and NAV loans and et cetera that happen on private credit funds as well. And I think a lot of the kind of simplistic criticism of direct lending in its early days, focused on like, oh, what are the parts that we can't see? What do marks look like, et cetera? And that has kind of continued to work its way through. And I think we see from the trailing performance that, obviously something has been figured out here. And so people have moved on to the next thing. And I think you see the new generation of, I guess, generic free-floating worries that people have about the private credit system is, oh, but what about like just the proliferation of products and the growing complexity? And I mean, I know from my own reporting that people are now talking about like hybrid products between the, start as a subscription line and become a NAV loan, or we're now seeing kind of continuation funds for credit vehicles, even though they're, amortizing assets and whatnot. So like, I think there is like a lot of complexity, which is maybe bewildering to the outside observer. You kind of touched on the point here. You said you don't feel that these are overlapping elements of credit. I was wondering if you could just pull at that thread a little bit. Like, what is it that you would say to someone who's looking at this and saying like, man, this is a lot of different products, like slipping in at like a lot of different places along the life cycle of, $1 of equity goes into the system?
The US financial system is incredibly innovative. And that is, without question, by and large, not to say uniformly, by and large, an incredible positive. I mean, one of the many strengths of the US economy, and we're seeing it, continued strength, increasing, probably dominance of the US economy at this moment around the world, is partly a reflection of having these incredibly deep, innovative capital marketplaces. And part of that, the private market's a good example of an innovation that is meeting both an investor need and a user of capital need. Now, to your point about complexity, I really like the way you phrased the sort of free-floating anxiety, because that's kind of what it is, right? People, they say, well, what are you concerned about? Well, I don't know, which by the way, I respect that answer, actually. I don't know. I just have some concern. Those people that's a great group of people because we're happy to sit with them, talk through the products, talk through the ecosystem. The ones that are I think, less constructive are those who say, oh, well, that's a real problem. That's scary. Now, a lot of that's very self-serving by competitors who are losing business to this private market. So, we understand that. That's just the nature, again, of a competitive market, perhaps. Some are people that I think where it's less productive is where it's coming from, some sort of policymaker view just because they sort of want more fingers into the system. I just don't think that's particularly productive because it's likely just to slow the flow of capital, and we need the capital. The key question, and I totally understand regulators asking this, and we work really well and happy to invite regulators to work closely with us too, regulators or anybody else that wants to understand the business, which is to say, look at the source of the capital. The real question to ask is the stability of the funding. Look, we may or may not be making, as an industry, great loan decisions. I think we are as an industry, and I'm highly confident we are as Blue Owl. But of course, there'll be some good decisions, some bad decisions. That, if funded with a very stable pool of equity capital, is just a investment challenge that will result in some investors doing less well than they hoped or expected. The real question to get to, and this is where I think one can get really excited about this whole evolution of the private markets, is are there dominoes that can fall? Is there an interconnectedness that causes a small infection to become a big one? That's the bank problem, right? That's Silicon Valley Bank. If you get people nervous and it turns out you have one-day assets that are essentially invested in 10-year loans, that's where your problem comes from. And the power of the credit market and the private credit market, and I really say this not to oversell it, but with a lot of confidence, this is a healthy dynamic. We have permanent capital. We have capital that never goes away in the bulk of our funds. Our business development companies, BDCs, not to overuse an acronym, the capital stays in the system. It's not even less than a possible run on the bank. It is an impossible run. That capital is there in perpetuity. So the returns will be higher, the returns will be lower, but you're never going to have the problem that created the great financial crisis through that system. You're not going to have the run on the bank, the toppling of dominoes. These are not highly leveraged vehicles, so sure, let's keep an eye on that. And these are long-dated capital vehicles. Let's keep an eye on that. If that's true, if we kind of look there, regulators, policymakers, people correctly that are watching this market because they care about the health of the economy and the marketplace, they should watch for that. And if they have firms that are developing long-dated pools of capital and prudently using leverage around it, they should view this as a great transfer of risk to exactly where it belongs. A long-dated loan matched with a long-dated commitment of capital.
Right.
A long-dated loan matched to private investors making informed decisions, not bank depositors who are counting on a government backstop. It is a great way to move risk where it belongs, where people like us can be vigorous risk managers and match assets and liabilities.
That does get into a question about what I think is like the last big, really new kind of moving piece in the market, right? Which is, like you say, the history of this segment has been, analogously to private equity or infrastructure or whatnot, is closed-end funds where you take in a bunch of commitments, like we were talking about, from limited partners, so pension funds or endowments or what have you, and that gets locked up for, say, 5 years, and there just is no run risk there. The composition of that is changing a bit, right? We're now seeing everybody is beginning to scale up their distribution through private wealth that is, developing products where individual investors can come in at much smaller check sizes, and maybe those do have some limited liquidity features so people can pull out some amount of money every so often. And then on the other hand, you have the really, really big opportunity, right, which is the insurance opportunity that you've seen a lot of folks moved into, some of your peers very aggressively, where you're beginning to match up all of the sort of premiums and reserves that are sitting at insurers and putting those into assets that match up with, I need to pay this person who has an annuity promised to them at a 5% return in a few years. Those are really, it seems, a different order of magnitude of size. People are talking about addressable markets there again, running up to like 100 trillion. And it also seems like a different set of concerns around duration, because that's really what we're getting to, right? Like, what is the risk from duration? Like, how do you think about that? And also, I don't know, is there maybe you want to talk a bit about what distinguishes Blue Owl in terms of how you're pursuing those opportunities versus the peer set?
So there are three core investor groups, and I'm just going to call it exactly what you said. One was the traditional group, which was the institutional investor.
Mhm.
The second is the individual investor, right? The private wealth channel, as I think is probably the most common parlance. Some people might say retail. The products really haven't gone as far as that term would probably imply, but what's the individual investor market? Let's just call it that, and then the insurance market. So, in fact, actually, it's sort of the three I's, right? The institutions, the individuals, and the insurance. So maybe you and I can coin that term.
I like that. The three I's. I think,
Just came up now.
definitely going to be using that in the future.
Yeah, I'm very fond of I've been trying to sell this idea of the three P's of direct lending, which is predictability, privacy, and partnership, which is why people pay for a private loan. And now I think we have the three I's to go with. So, of the three I's, the institutional market is kind of, if you will, obvious, right? That's been the market for decades. And it's been a very successful market because, back to this will always be my Occam's razor, because it works. Like the simplest answer is obvious, which is it serves to create higher and better returns for the risk for institutions. Okay, well, now there's two other classes of investors who likewise can benefit. When we started Blue Owl, our observation was that's the second of those I's, individuals, that we ought to democratize access to these products. And we ought to do that because it will allow individuals to benefit, done right, from all those same things institutions already figured out were benefiting them. That's why they went from having 5% of their portfolio on average in alternative investments in 1995 when I joined the industry to 20 years later when we started Blue Owl, they had 25% of their assets in alternatives. Well, individuals want to and should benefit from those same opportunities. Some match better than others, so we should get on to, but that doesn't mean every product serves each market the same way. So our view is democratization was a really good thing to do to benefit the individual. And by the way, that's not a selfless exercise. Democratization is a very high-minded sounding version of, market products to individuals. It's true democratization. It's real. And it's a nice way to capture the idea that we are delivering something that otherwise was sort of held only to the institutions. But it's also a self-serving exercise. It's a great big marketplace. And by doing a good job, we've grown 40% of our assets are from individual investors. Like it's a big part of our business. KKR, Blackstone. I mean, I listen to any earnings calls of theirs. It's all about individual investors for the same reason, because this market is a big one and we can do a good job for it, done right. So let's we go back to done right, what that means. And we will. There's certain products that match better than others. But then you mentioned the insurance market. The insurance market, clearly another marketplace that over the last, likewise, 10 years has had this evolution. And we acquired an insurance services and asset management business for this reason, which is in and of itself, the underlying products, direct credit, asset-backed lending, hyperscale data centers that are leased, triple net lease real estate. I'm using a lot of verbiage, but these are real products we offer are fantastic for insurance companies. They have their own needs. They care about ratings in a way that individuals aren't going to care about. There's scaling differences. There's duration differences, to your point. But they're a perfect marriage because they have the ultimate long-dated capital, right? Asset liability matching. So when you put the three I's together, you have people that all will benefit from certain alternative strategies, but all need them delivered in somewhat different ways. Individuals will value some measure of interim liquidity. Institutions will not really meaningfully value that. Insurance doesn't even want that. I mean, insurance is saying what I really need is the ultimate long duration match. Like when we have a 20-year triple net lease real estate product, which is one of our premier products with investment grade counterparties, what a perfect marriage to someone who has a 20-year expected liability in their life insurance.
Yeah.
So I think it's about tailoring and being thoughtful about meeting the needs. Again, I always come back to this is about delivering for the LP. If we, not just Blue Owl, for sure Blue Owl, that I can quote control, but as an industry, keep an eye on do a great job for your LP, match to their needs, we will do well as a business. Like, look, let's let the right order of events occur. Do a great job, great credit decisions, great returns, great real estate decisions, great GP stakes decisions. Let's make a really good set of decisions. democratize them so everyone gets a good experience, whatever channel they come to us in, then we will build a good business. That will be the output as close to the input.
And in building that great business, right, you talked about design it right is the big question. And I think on the individual one, you also touched on something there that's really at the heart of that, which is, like you said, individuals might have this desire for liquidity. And also, we want to democratize, we want to give access. And I don't know, maybe this is too simplistic a way of thinking about it, but there's, to my mind, this sort of pendulum that swings between the idea of what we are doing is focusing on the access part of the question, e.g., somebody further down the scale can actually buy into this product, and another one that focuses on the liquidity part of the question, right? Which is, if we make this product substantially liquid enough, that will ensure people come in. And I just wonder if you think that that's the right schema to be thinking about it through, and if so, like where you begin to hit trade-offs on either of those ends.
Yeah, I actually, the way I view it is through the following lens. There's the underlying investment strategy, and frankly, underlying investments, not just strategy, because that could just be a word, right? We could say, the underlying strategy is private credit. Okay, well, that's both a rangy word, but also you could develop a lot of different portfolios. Blue Owl's view on this, and this is a very strongly held view because it's been part of what we did from the inception, is it is critical that the individual investors get access to the same origination pipeline and the same quality investments that the institutions get. They don't. I don't think it's an optimal world where the individuals are getting a whole different portfolio. The whole purpose of democratization was democratization of access to the good stuff that the institutions have been getting. So I don't think, by and large, it's a very healthy strategy to end up having a completely distinctive pool of assets for individual investors versus your institution. So first, let's make sure we're giving individuals or insurance companies, so any of the I's, access to the same underlying investments. So that'd be, to me, kind of point one. Point two, then, as you say, is kind of level, and if we got down to it, there are a lot of variables, but level of liquidity, so to speak, is often the one you hear talked about, right, within the range of individuals versus institutions. There are other things, by the way. There are tax attributes, BDCs, business development companies, right? They produce 1099s, much simpler tax reporting. If you don't have anything, if you're a non-US investor, there are tax complexities to being in funds that are eliminated by business development companies. So there's a lot of features to look at, but let's just take liquidity because it's the central topic, I think, as retailization, wealth access to these products has come to the front. Let's start with the notion that just taking a strategy and putting it in a so-called individual investor vehicle isn't at all can be for liquidity. I mean, so I do think, let's start with this. You've got to ask the detailed questions. You have to talk to your FA, talk to the GP. These are not all the same. Just saying, here's my product and I will offer quarterly liquidity doesn't make it liquid. You got to ask yourself what the underlying products are. And I think the heart of your question is, are there trade-offs? Somewhere there have to be trade-offs. Let me take an extreme. If I take a product like private equity, which again, it's a product I like, but if I just put it in a continuously offered product, it didn't magically become quarterly liquid. Like from what? Where's the money coming from? I mean, unless you sell a company, which is very episodic, there isn't liquidity. You don't generate any returns on current form. So what I do is I generate these markups to net asset value, kind of a promised return for the future, until someday I can actually deliver it. So you can't just magically all of a sudden invent liquidity. Credit, on the other hand, credit in our products, we have hundreds of line items and loans are getting repaid at all different times. There is a natural rhythm of liquidity. We use one turn of leverage on average, which also means we can modulate leverage up and down a bit to create or reduce liquidity. Most importantly, I think, for matching the individual investor market, our returns are generated in current cash and we send them to you. So there isn't this IOU idea building up of, I'm telling you you're doing great, but you're only going to know it if you come and ask for your money back. So I actually do view this democratization and the creation of these so-called continuously offered products or these retail products or whatever word you want to attach as an incredibly positive development for the industry, an incredibly positive development for individual investors. But make no mistake, you need to be thoughtful. And if something seems too good to be true, then it's probably too good to be true, or you better be able to explain it. And that's what I always go back to is ask someone to explain to me why it works. And I can tell you, I can't just make an illiquid thing liquid by waving a wand. So if something's inherently deeply illiquid, it didn't all of a sudden become liquid another way. But I can take something that has a lot of cash flows that vary over time, and I can create, therefore, partial liquidity. So I think this is going to be itself an evolution. I think it's very exciting for the more you get in yield, the more I can give you in current return. If you want a simple rule of thumb, the better a match that is to a continuously offered product, because at least I'm getting my income and my return along the way. It's not all on account.
Right. And I mean, that's fascinating, just given the moment we're in with this proliferation of products for the retail market, right?
Yeah.
So I think that's as good a place as any to wrap it. Marc, thank you so much for taking the time to join us.
Can I volunteer one comment? I think
please.
Through this discussion about the evolution of the markets, what we are seeing in any market, there will be, obviously ultimately winners and losers for sure. But I think it's safe to say that the entire capital market system is a beneficiary of this development of, it's not a replacement of the whole liquid market. I really do intentionally use the word complement too. The private market is a great solution for certain users of capital. And it is a great place to invest for certain investors or certain parts of their portfolio. It is not a panacea. It's not the singular solution for either. Liquid markets for investors play a great role. A lot of times people should have assets and things that they can for sure get the next day. They ought to have some of their, maybe even a lot of their portfolio on that. Depends who it is. And for a user of capital, they may really value the partnership that comes with being able to work with Blue Owl and all the things we can do to tailor solutions and meet them where they're going and together skate to where the puck is going. But some people don't. They're just saying, look, I just need a lot of very inexpensive capital. That's not the reason the private market exists. We're not the answer for that. If you want the cheapest capital, I don't think the private market is necessarily going to be your answer. So all these things are nuanced. And where I wanted to go with this is Jonathan, your understanding of this market is extraordinarily nuanced, extraordinarily good. And so I would say this, people should listen to your podcast if they really want to get into unpacking these questions, because there is otherwise just free-floating anxiety. What I would tell you is this, there's no need to have free-floating anxiety. You can have a grounded understanding, and then you can develop your own grounded anxieties about things that will work or won't work and make investments. That's the way markets work. But there's nothing scary about this once you unpack it. You just need to take the time to unpack it.
People have to pick and choose their anxieties. Marc.
Yeah, I play my own.
Marc, thank you so much for your time.
Thank you. Great being with you.
That's all we have time for this week. Thank you to Marc Lipschultz and Jonathan Guilford for that fascinating discussion. And also thank you to Marc for that very fulsome praise for Jonathan at the end there. I'm sure he wasn't remotely embarrassed by that. This podcast was produced by Oliver Taslich in London. You can listen to a new episode of The Big View every Tuesday on the Reuters app or your favorite podcast platform. Don't forget to tune into our sister podcast, Viewsroom, every Thursday, as well as the other great podcasts from the Reuters team. And if you liked what you heard, please follow The Big View and let us know what you thought. And check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.